always, anytime someone says you have to make a decision in a short period of time, the answer is, oh, that's not a problem. The answer is no. See you later. Never feel bad about that. Don't let someone put you in that position. And don't let someone say this is a once-in-a-lifetime opportunity, because there's no such thing as a once-in-a-lifetime opportunity. As you go through your life, that opportunity will arise over and over and over again. But when you're in the heat of battle and you're looking at it, and it's happened to me several times, where I thought, this is a once-in-a-lifetime thing. Not true. Not true. So never get pushed to make a decision like that. Okay? You'll have plenty of opportunities. All right. Shifting over to liabilities of life companies. Okay? You have policy reserves. Okay? And you know you've got to pay death benefits. That's going to happen. They have an army of actuaries who know when you're going to die based on pooling. Okay? And life insurers offer level pay policies. This was a very important breakthrough with life insurance. Okay? These policies charge the same premiums for a long period of time. It's called level premium. So you might buy a $500,000 or $1 million life insurance policy for a 20 or 30 year period of time, and you lock in a premium that never changes. And then there are all sorts of variations, okay, in premiums that you can structure. Okay? Why do the insurance companies do that? So they can sell you policies. Okay? They may sell you a policy that's like an adjustable rate mortgage. The premium is low for the first 3 to 5 years for a young person who's just getting started in business, and then they say after 5 years we're going to kick it up to this amount. Why? Because you're going to be making more money. You'll be able to afford it. So we're going to undercharge you basically on the front end, but we're going to make up for it on the back end when you're making big money. Okay? So the way these things work is you pay higher premiums early in the life. Why is that? Because the way that works out, when I say higher, when you look at your mortality rate or the probability that you're going to die, when you're young, it is quite low. So the expected loss for an insurance company when you're young is tiny. So they're able to charge even more when you're young, because as you age, your mortality shoots through the roof. And if I went to renew an insurance policy right now, it costs me 5 or 6 times when I'm paying. I've got a level pay policy. But if I said I want $1 million policy right now, how much will it cost me? It'd be at least 5 or 6 times more than what I've been paying for the last 20 years. Because the probability of loss is so much higher than it was 20 years ago when I bought that policy. All right. So they front end load early because they know later on they can't charge you $10,000 a month, you know, for $1 million policy. Nobody's going to pay that. So they quote you a level premium over the life of the policy. And again, we haven't talked that much about regulations with regulators and cases, court cases like that, but insurance companies are regulated on a state-by-state basis, and one of the things, obviously the biggest obligation that a life insurance company has is to pay the death benefits. They've got to have the money available when you die. That's what they do. So life insurance companies have two other types of reserves. Okay. So amounts held on deposit, these represent funds that are owed to policyholders and to beneficiaries. So let's take a look. Okay. So it is typical for a beneficiary to request a fixed period or a fixed amount death benefit settlement. Okay? Fixed period, and we'll go over this in the life insurance section, but fixed period means I need this policy to pay out for 20 years. So the actuary says, okay, it's a $1 million policy. We'll guarantee you a payout of $7,000 a month for 20 years. Now at the end of 20 years, we're done. You may still be living, but we're done. That's our agreement with you. We're going to pay for a fixed period. Or you can say, I want the $1 million paid out, and I want it paid out $10,000 a month. Now you offered me $7,000 a month for 20 years. I need $10,000 a month. $7,000 not enough. And if it runs out in 15 years versus 20 years, so be it. I'll put the garage door down and start the car. That's called the fixed amount death benefit. And the insurance companies offer different settlements. And with both of these, the $1 million that they owe you stays at the company, at the insurance company. And they want it to. Why? Because they're going to invest it. And they're going to earn a rate of return on it, on your money. Okay? That's why. But they're providing you a service. They're not ripping you off. It's just business. Okay? But those are decisions that you have to make. Lots of decisions that you have to make. See, now we're starting to get in line. Isn't it cool? This is interesting stuff. All right. So you get a series of payments. It's an annuity. Instead of them saying, here's your pile of wealth, they're going, here's a little bit at a time. Now, if you've got a special needs person, or you've got somebody who just has no discipline with money, you could buy an insurance policy and set it up to pay $10,000 a month or whatever it is to cover their living expenses. And when they come in and say, no, I need an extra $4,000, you don't want that to happen. Because if they keep doing that, they'll run out of money. And you're the responsible person, so you're going, no, this is how we're setting it up. And you can do something similar with a will or a trust. With a trust, is you have a trustee who says, we just did a deposit in your checking account for $10,000, and that's all you're getting. So don't come back to me, and tell me you need more money, because you're not getting it. All right. Okay. Another example is accumulate at interest, and this has to do with dividends. Okay. Dividend option. Okay. So, policyholders tell the insurance company to hold dividends at the company. Don't pay dividends out to me. Okay? Hold the dividends and pay me an interest on the dividends. So I'm going to earn dividends from you, and then that's going to go into an account. It's called accumulated interest. And we're going to hold it in the account, and the account is also going to pay interest on it. And that starts really small. You might get a dividend of $75. and you look at that account and go, how much is my account worth? $75. Okay? And it's going to pay 5% interest, so that would be $3.75. You go, woohoo! I'm rich. But 20 years later, you know, now you got, you might have $100,000 in dividends in that account, and now it's paying $37.50. It's earning $37.50 a year in interest because it's accumulated, and that's the beauty of time. And you haven't had your hands on it where you could spend here and there, and so you go back into it and you look at it and go, wow, isn't that nice? Okay? And that's added to the death benefit. So you might have $1 million policy and you end up getting $1,200,000. You got a 30-year-old policy that has a $200,000 interest dividends accumulated. Okay, that's a nice bonus. All right, I think we're going to stop there. Let's see how many we have. We got 27. Let's go ahead and stop there, and we'll finish this on Tuesday. Okay. I don't want the video to be too long. All right, so we're good. Peace out. Shalom.